Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The Dow and S&P 500 hit record highs on news of ultra-positive job creation in the U.S. Ross checks out crude, gold, sulfur, and chocolate. Publisher of the VRTrader.com newsletters, Mark Leibovit, checks in from Arizona to chat about what he expects from the major stock markets this year, interest rates, cannabis, and gold. He also has a special offer for our listeners. Publisher of WolfStreet.com, Richter, gives us his view on the U.S. real estate market, inflation, the auto market, where it appears North American heritage companies are falling rapidly behind in the electric vehicle sphere. We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to the show.
Good to be with you, Jim, and another big week in the markets.
Ross, what happened with the stock markets? Did they bounce because the U.S. job report was so positive?
Well, you got a combination of things. You got employment numbers that came in at twice the estimate, 353,000 new jobs in the States. And then this week, this is the heavy week for earnings on the big names. And on Wednesday and Thursday, boy, did they come through with some decent numbers. You got, on the day here, you got Amazon up 7%, Meta up 20%, NVIDIA up 5%. And each one of these companies has a market cap of over $1 trillion. So we're talking about big bucks here. We're not talking about little stuff. So, with that, the indices here, you've got all-time high closes in virtually every index, I guess, except the Russell 2000. The rest of the board has been pretty strong. The AD line, which had been slow in terms of moving up off the recent pullback, did decently as well. We're in the seasonally favorable period, end of October through until the end of April. So it's a question of, what kind of pullbacks do you get? These markets are very overbought. There's no question about that at this point. So, there's bound to be some pullbacks, and, they could be sharper than most people might be expecting. But for now, trend is up, and the lows that we put in here within the last week and a half, I think you want to watch those pretty closely, as this market just is stair-stepping its way up. Every time it makes a new high, the pullbacks are becoming milder and milder. So, my rule of thumb was always that I'd look at the short and medium-term moving averages, and within a methodical trend, you would test your moving average 2 or 3 times, and then you'd drop to the next further one in terms of duration. So you'd go from testing the 20-day moving averages to then the bigger corrections would be at the 50. And as you moved along, things would become exponential, and you might not even make it back to the 20. And that's what's starting to happen now. So we're becoming exponential. When you roll, the corrections will be decently deep, and those that have been buying into the final end of the move will find themselves offside for who knows how long.
What's going on with crude?
Crude oil market, seasonality, you got the December low typically bounce into January. retest of the lows late January into February. So right now, we've had this decent move up until a week ago. We got up to $78. And this week, selling off, we're back down to 72. The support area at 68 and change. From a seasonal perspective, this week coming up now, the second week of February, is usually the final low before you can kick off for the bigger seasonal move on the upside, and that could easily take us through the $80 range. So you want to be looking pretty closely here for any signs of a reversal in the oil. I think we've had, 3 down days right now. And, you might get a little bounce for one day or so, but if it can bounce for more than one, the seasonal play on the upside could be ready to kick off.
What's happening with gold?
Gold, we've got that seasonality there. The mid-November low typically is the starting spot, and we had that spike up into December, testing making all-time highs just fractionally. And since then, you've had 2 marginally lower highs, but we're putting in marginally higher lows as well. So this gold market is itself boxed into a nice little triangle, supports at the 50-day moving average, which is just a shade below where we are at this point. The seasonal play can take us right out through the end of this month, so I would suggest that if we can take out the high close that we had in the last 2 days, that would be on January the 31st, February the 1st. If we can take it out on a closing basis, gold could be ready for a decent run on the upside.
What's happening with the U.S. and Canadian dollars?
Well, with the employment numbers that came out today, the U.S. dollar has managed to just eke itself above the resistance. So it's 103.90, just a shade above the 20 and 50 week moving averages. That had been a resistance level. We'll see what kind of follow through it has at this point. And to say it's moved on news, and with the employment numbers the way they are, the probability of a drop in U.S. interest rates at the next Fed meeting appear to be off the table at this point. They were a possibility, but that seems to be off the table.
Now, a financial cocktail that I don't think would be very tasty. Sulfur and cocoa, though, would be very costly.
Would be quite something, wouldn't it? Yeah. Cocoa sitting at the highest levels that we've had since the 1970s. So, the chocolate bars are just getting smaller and smaller, but the price tags keep going up. And sulfur here, they're having some difficulties at some of the major outlets as terms of the production of uranium. So uranium prices have popped after a little bit of a pullback here, have popped back to the highs. And, there's a trend that clearly, has been in motion since, 4 years now. And the corrections are meant to be buying opportunities anytime that uranium takes a decent pullback.
Ross, thank you so much for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Mark Leibovit, next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRtrader.com. He's speaking to us from Arizona. Welcome back to This Week in Money.
Glad to be back, Jim. Thanks for having me.
Mark, do you have a special offer for This Week in Money listeners?
Yes, we do, and it is particularly relevant right now because this week we're going to be publishing our annual forecast model, which no indicator is perfect, but we've been publishing it since 1987. And last year it more or less perfectly tracked the market pattern in advance, showing these cycle highs and cycle lows for the year. We've had several subscribers anxiously trying to get their hands on it. It should be out early next week. And it sort of gives you, of course, we follow a lot of markets. And, it covers, for example, last year we had a sketch what we thought crude oil would do for the year, and it tracked it out pretty closely, and in particular Bitcoin. And we also have it for the Dow Industrials and gold and copper and silver and T-bonds. And so we have this cyclical report. It's called the VR Forecaster, and it's once a year, one-time purchase. So if you go to VRtrader.com, it's $900 for the full retail price, but if you enter the promo code 2022 half off, you get it for $450, which is half off. And believe me, it's a steal in terms of getting a cyclical view of what these various markets might do in 2024. So again, go to VR Trader, and it's called the VR Forecaster. It's right up on the home page, and use that promo code 2022 half off.
Mark, can you tell us a little bit about VR Trader?
Well, VR Trader has evolved over the years. VR stands for volume reversal. That's my technical trading tool. Volume precedes price. So when I get a reversal of price and volume, particularly off bottoms and tops, that gives me a trading signal. It can be used on 5-minute charts, 60-minute charts, daily charts, weekly, monthly charts. And it's unique. It's not something that's on platforms all over the planet. There's other major technical indicators, and you can only read about it at my website, or if you go to a platform called Stock, which is the oldest technical trading platform in existence, I believe. I think it was launched in the mid-1980s, and one of the add-on indicators you can add on if you subscribe to Stock is my VR volume reversal indicator, and it plugs into the program, and then you see the little signals up on the screen. So I use these, but I've also, over the years, it's like the old weatherman, he makes a forecast, but you want to look out the window before you make a trade, and we, look at the cyclical forecast, we look at the news, we look at contrary opinion, all kinds of indicators, and a couple other tools like overbought, oversold readings to try to time stuff as best we can. So the combination of VR Trader is a combination of a lot of things that have evolved over 44 years.
Mark, are you a financial advisor?
No, I am not. Thank you for asking. I do not advise, and I'm not registered to advise people, so I'm not the financial advisor, nor do I provide financial advice. Used to do that years ago. We had a hedge fund back in the early 2000s with a group here in Phoenix where we actually shorted REITs in anticipation of the collapse of the real estate market, but that's the last time I've been involved in the money management business.
The Dow and S&P 500 have hit new all-time highs this year, short-term and medium term. What do you see ahead for the Dow and the S&P this year?
Well, I've been giving out a lot of what my forecast is saying, but let's put it this way. You've got a big divergence in the market right now. It's almost hysteria what's going on with regard to a handful of stocks, in particular the Magnificent Seven that everybody's so excited about. But it's interesting in trading today, Friday, you actually had 3 of the Magnificent Seven stocks down. Apple Computer, Tesla, and Netflix. And the biggest move was in part of one stock, which was the old Facebook, which they now call Meta, which had a big move up 80 points on a news release. Of course, NVIDIA was up as well. That's been the big favorite. So, it just doesn't sit well with me. It's a big divergence. I guess if you own just the 7 stocks or 3 or 4 of them, does that Is that your portfolio? And I suppose if you are in those, you're happy and smart. But for most stocks, it's not been as good a year. And if you're in the indexes, they are moving along with the big ones. But it's a big divergence, the way I read it. I just don't like a market that is, led by 2 or 3 stocks. You want to see broad-based follow-through, and we still have divergences out there. The Russell 2000 is not at new all-time highs. The mid-cap 400 is not at all-time highs. The so-called leading Dow transports, which is supposed to be the leading indicator, is not at all-time highs. So, just a couple indexes led by, a couple, very powerful stocks that are generating a lot of interest and impact on the Dow Industrials, and particularly S&P. When you think of 500 stocks and 7 of them that account for 25 to 30% of the gain. So it's a big divergence, and you do this for a lifetime, as I have. It's not something you're comfortable with. You can trade those stocks and make money, and we do trade special situations and all along the way. But in terms of just a philosophical stance of where the market is, I think it's dangerous when you these type of divergences. But there is action, and you can find places. I'll give you an example, since we're just talking about other alternative plays. One of the big winners for us, I know people are going to laugh, but in the last few days, some of these low-priced cannabis stocks really took off. We had some nice trades today for our VR trader clients, and some of the names in the U.S. Cannabis space, which are running, because apparently there's an article that came out about 10 to 15 U.S. senators are pro the DEA rescheduling cannabis from the number 1 level down to number 3, which is, makes it more accessible. So a lot of, big percentage gains in some of these low price things, and they probably will continue to do well once the rescheduling does occur, which it probably will. I can't give you the exact day, but the market certainly anticipating it. And then you have the U.S. Banking Act, which is still pending. If that changes, it gets passed, that's going to help these companies. So a very depressed group, took off here and, did well for us. So a lot of, just interesting things happening. It's an exciting week, actually, in terms of some of these trades. And, we just try to stay on top of it as best we can. The old expression was we all talk about is, there's a bull market somewhere and there's stuff going on. So if you're in NVIDIA, you're in Meta, you're in a few cannabis stocks. Actually, one of our stocks, Taiwan Semiconductor, which makes sense because of what's going on in Taiwan. It's also based here in Phoenix now. They're building a huge plant here. That's been a hot play in recent sessions. Uranium has still been positive. So, there's definitely opportunity up there. But as far as the overall market's concerned, I just don't like the divergences. It just rubs me the wrong way after doing this for so many decades. And ultimately, we pay the price when you see, very few moving and the rest of the market not doing as well. So we'll see how it all plays out for the year. It's a little too early. We do have an election year, and we'll just, take it a day at a time. We also had Groundhog Day today, which you didn't ask about. Well, Punxsutawney Phil didn't see his shadow, so apparently there's spring is going to come early this year. But the other point about good old Phil is that I've been writing about this for many, many years. Within 2 weeks of Groundhog Day, you generally get market volatility, meaning downward action. And just a day and a half before this Groundhog Day, we had the huge market sell-off, right, tied to the Federal Reserve meeting on Wednesday of this week. Then, of course, it bounced back Thursday, and now today was sort of up again. But just around this time frame, I've been writing to watch out for a lot of volatility. And it's based on cycles. It just happens to be coincident with the February 2nd Groundhog Day event. But there's more to it than just that day. That day, February 2nd, apparently has some cyclical impact, planetary or otherwise, that, whether groundhogs are involved or not over the years is a warning signal to me. So you may see a market turn down here sharply. It's still within this groundhog time frame, which lasts 2 weeks either side of February. And we do have coming up the vernal equinox in March. And I warned about this for a long time. There's, many instances, not perfect, but you get low in the market around that time frame. Some of the biggest lows occur. The big classic one, of course, was a couple of years ago during the COVID event on March 2020, where the market had a huge bottom. So I'd be careful here from a cyclical point of view, from a groundhog point of view, and from a divergence point of view in the overall market, as I just discussed.
The NASDAQ is close to setting a new all-time high. Do you think we'll see new highs in the NASDAQ this year?
Well, we've already seen them, so I guess it's setting the precedent so long as the Magnificent Seven stocks are attracting investor attention, NVIDIA and AI and so forth. Is it possible they'll continue moving higher if the overall market has a correction? It's a tough call here. I wouldn't be chasing them. You have NVIDIA, running from $400 to $680 a share, and Meta, which is the old, Facebook, rallying about 150 points here in the last week or so. That's disconcerting. So I think they're going to run out of steam here a little bit here short term. I think you've had a blow off.
The Russell 2000 is nowhere near its all-time high back in 2021. Do you think this will be a good year for the Russell 2000?
Well, when the market eventually bottoms and turns up, probably yes. I could see, later in the year that we see, a resurgence of other stocks besides the only big seven stocks that we're talking about. So a lot depends on, market psychology. We have, no one's talking about it, but we've entered a world war. I mean, in the old days, we talked about this off air, the Gulf of Tonkin incident back in the 1960s. Now we shoot planes down, we bomb facilities, and for some reason it's not called war, but it is war. And at some point there's going to be a mistake, or something's going to happen, and it's going to get out of hand. That could be the Russians have the EMP technology, which could put us out of business in terms of our technology. Once one of these things goes off, we don't know what Iran's going to do or not do, or what mistake we make or not make in terms of attacking people. We have so much going on in the world, but it just bugs the hell out of me. I mean, I turn on financial television, and the total discussion is either AI or what the Federal Reserve is going to do. It's like you have a hurricane coming at you, and you're not boarding up the windows. You're not preparing for it, and you're looking at your financial statements and seeing how your companies are doing, where your personal safety could be jeopardized, and your life could be changed dramatically. And it's just a bunch of an ignorant approach to the state of the world. So we're just moseying down the lane here, thinking everything is great, and I don't think that's the case at all. It's just common sense. We have the border being invaded here in the U.S. It's one of the most tragic events that we could possibly see, and we have people running the government who are either traitors or just incompetent altogether. When my grandparents came over here, they had to go through Ellis Island and be interrogated one by one to come into this country. And now they opened the borders. This is obviously, sedition of some kind on the highest level. Serious things are happening. And, forget Ukraine, forget Taiwan, forget North Korea, forget the Houthis bombing our ships. I mean, there's so much going on, but it's not important. It's only important that the Federal Reserve lowers rates this year so stocks can go up. So it's like my analogy to a hurricane. You're not preparing for what could happen.
This week, the Fed kept the rate hikes on pause. Are there scenarios for the Fed to begin raising rates again or to start lowering rates?
Well, it's political pressure, obviously, at work here. You have an election year. I'm sure Jay Powell's had conversations with Biden and other Democrats about what he should be doing and not doing during an election year. So the pressure is on to lower rates. Of course, the market itself, it's the tail wagging the dog, Jim, because the bond market is not run by the Fed. It's independent. So only short-term rates are controlled by the Fed. And the bond market's been rallying, and Fed has no control over that. That's bringing down mortgage rates. And, of course, political pressure on the Fed. And everybody was predicting, at least in December, about 6 rate cuts here in 2024. Now I think they're down to about 3. So it will come down a little bit. So what's it going to come down to? 2 or 3 quarter point declines. It's certainly not going back to 2.5%, 3%. So as it comes down, it's a psychological positive, and it should help, short-term the real estate market, I suppose, a little bit. It's still expensive, though. The rates are still overall high, even if they drop them a little bit. But the psychology of it, and since it's street, quote-unquote, the Wall Street people and commentators are so fixed managers. I mean, it's like lemmings jumping off a cliff. I mean, they all talk the same language, and as the rates come down, we have to go buy stocks. And they started to do that, as you know, in November, December, when they felt that rates are coming down and we have to get invested. And just it became a waterfall. People just following people, fearing they're going to miss the rally, short covering coming in, and it just sort of got out of hand here a little bit. So, I suppose, they'll rally them tied to the interest rate story once the rates, anticipating or the actual event. It's funny, though, in history, at least some of the history I've studied, when the Fed starts lowering rates, it's because of some negative event, something else is going on that they're trying to overcome or prevent. A couple things. I mean, for example, war could be one of the reasons. Attack on our country or some other event like that. Just like they reacted during the COVID event or during 9/11. Certain preventive strategies are employed. As also, we still have problems with the regional banks. The KRE index, which is the small bank index, had a nosedive here the last couple of days, and one of the participants had a problem. I forgot the name of the exact bank. So there's still a problem out there with the small banks here in the United States, and the Fed may be, out there doing stuff behind the scenes here to assure there's not a banking collapse. As you recall, last year we had a big sell-off in the market when the Silicon Bank ran into a problem, and there's still these banks out there, many of them, that have invested in bonds with long maturities at low rates, and the Fed had to come in and backstop them and guarantee them against any losses on their long-term bond portfolios. This is still going on, and there's some key dates coming up mid-year where some of the assurances that the Fed apparently had given some of these regional banks expires unless they renew that. So the banking crisis may not be over yet, and unlikely it is, unless the Fed just guarantees everything forever to these managers at the banks who made very stupid moves in buying long-term bonds at almost zero rates, and now they find their portfolio at huge losses when those bonds were repriced based on the current rates. So it drove the value of those bonds way down and jeopardized the bank's existence. So it's just that's another variable out there, what could happen. Or maybe the Fed will be forced to lower rates and get more protective, which will be viewed as positive for the stock market, I suppose, because it's like pumping money into the system, but it really is reflecting a very negative situation out there. So a lot of stuff going on here. It's, you got to trade them. I don't know. Maybe you have to be a little dumb and you just buy the S&P and go take a 10-year vacation and don't worry about any of the ups and downs, and ultimately it goes up, I suppose. But I'm more fine-tuned than that. I trade the market, and I'm more concerned about shorter-term swings. But I guess if you want to be a big-picture bull, you're correct, because the government's always pumping money in. The stocks tend to always go up, and if you can ignore 20 to 50% declines in the market or your stocks along the way, then I guess it doesn't make a difference. But I'm more fine-tuned than that.
With this being an election year, are stock markets likely to be manipulated higher?
Yeah, well, they already are, and I think that part and parcel to the rally that we've had. So yes, it's been the Federal Reserve and political persuasion.
Are wars bullish for stock markets?
That's a good question. I put a chart up in our newsletter about how the market acted during World War II. And generally, if you look at how it acted during World War II, it was dropping just prior to Pearl Harbor. It's as if the market knew it was coming, which some conspiracy theorists, maybe it's not conspiracy theorists, but others believe was the case. And then once the shooting started, it started to rally. So the old expression at war, it could be good because it creates jobs and opportunities for companies. And that's one of the reasons why people are saying, well, maybe China would want a war because they've had economic struggles over there and a lot of financial issues. Their real estate system has been in trouble, an extension and valuation of properties, and the banks had some difficulty, and China got really nervous the last couple of weeks. They put out an edict that you can't short sell stocks. They want to keep the stock market from dropping over there. So, maybe they want to start a war to help get things moving in China. And that theory is out there, and it could happen as a way to stimulate their local internal economy. So the answer to your question is it's probably yes, probably bullish.
Are wars bullish for the price of crude?
It should be. It depends whether we generate more production here in the U.S. or not during a wartime scenario. Normally, if the supplies are being, jeopardized, then it would drive prices higher. And, we've seen of course, crude oil took off after the Ukraine situation started, and now we've had the Houthis attacking ships, but crude has actually been going sideways or lower, so it hasn't had an immediate impact, and possibly could be because we're having pretty good production here in North America, despite the negative actions of the part of the Democrats and Biden trying to suppress oil and oil production. In fact, today I think it was Chevron, a big oil company, as you know, came out and raised their dividend. Stock was up like 5 points, even though crude oil was down today, because they're making money. And they said they wanted to have their shareholders participate in the profitability of the company. So the oil companies apparently are doing okay. And to answer your question, oil, if they produce more and things are loosened up on the oil production side, normally you would expect, like people expect gold to go up if some war starts, for example. Doesn't necessarily follow. It could just be the opposite. Maybe our production is so good that we can offset it. And of course, the Saudis could also increase production if they wanted to or needed to. So though I'm a big picture bull on oil, because I still think we're a long way from being independent from crude oil needs by any stretch, tying it to the EV market and all that nonsense. But, big picture, I'm bullish, but short term, it may not have the immediate effect that everybody's looking for. I think cyclically, though, we are in a time frame that we should be looking for some type of low point here from a trading perspective. So we're watching that carefully, but we are keeping some positions, particularly in our favorite stock, Occidental Petroleum, which is Warren Buffett's apparently favorite as well. So let's see what happens.
Does more debt lead to higher inflation?
No question about it. I mean, look at what's been happening in this country. Federal Reserve was created in 1913. Value of the dollar is down about 98% in value. We've been pumping money. The dollar has been going down in value. Purchasing power has been reduced. Costs are going up. We're printing ourselves into oblivion. And at some point, we're going to pay a price for it. And who knows what that price will be. So it's definitely a negative, and one of the reasons, you contribute it only to supply chain issues, or you can attribute it to COVID. You could attribute it to a lot of things, but ultimately you're spending money you don't have, and that's the big problem.
The U.S. dollar and gold both continue to be in a trading range. Are we likely to see breakouts for gold and or the U.S. dollar anytime soon?
Right. I'm a little uncertain about what the U.S. dollar is doing here short term. It seems to have a big break. It's trying to rally here, which is theoretically not good for gold. Gold was down sharply, in fact, today. During the day, it was down almost $30 an ounce intraday, and the charts say it could possibly break into the high 1900s. But my overall chart says we're going up, and I think part of it is the fact that world banks, central banks, and others, not to mention Russia and China, have been accumulating gold. And, there's been a lot of manipulation in this market. I write about it a lot in our newsletter. Not much discussion about that in the financial press, about the impact of, gold suppression attempts on the part of the government to depress its price using the COMEX in New York by selling contracts against bids and trying to keep the price down. And I think that is intentional, because I think by playing with the futures market and depressing the price, the powers that be can accumulate the physical gold and they'll run it up. So, I'm bullish. I think the action is telling us, except for maybe a short setback here, you're going to see substantially higher prices here in the next year or so.
Are higher interest rates starting to have an effect on real estate?
They already have. In fact, I just spoke to a couple of realtor friends of mine just this morning, and it seems like everybody's sort of frozen. The sellers are not dropping their prices. They're sort of sitting still, and some are doing it, but not aggressively. The buyers are not rushing into with bids yet. Part of it is the financing cost. So sort of a stalemate right now. So I think rates have to really drop, the mortgage rates, that is, not necessarily the Fed short-term rates. That would be a big catalyst. And then perhaps some of the sellers are going to have to perhaps be a little more flexible on their pricing, and they seem to be holding out a bit. Of course, there are exceptions. There's some markets that are really strong regardless. It's really a seller's market in certain locations around the country, mostly in the high rent districts and in areas that are away from the big cities that have all the social problems and the immigrant issues that are plaguing, for example, New York and Los Angeles. So I guess more of the non-sanctuary states, for example, like Arizona, Texas, Florida. These areas, I think prices have been holding up a lot better because people would rather be there than in the problem areas, Chicago being another problem area, for example. So, some of these cities are saying, if you're in the suburbs, you got to take some of these immigrants and house them and take care of them. Well, you don't want to live in those places because you don't know who these people are, and the onslaught of these immigrants into the country that have not been, cleared and scrutinized is a big risk for the average citizen. Personal safety, health, you can go down the whole list. So I wouldn't want to be there. So you want to be in the places that are more stringent about who should be living there. So I think to answer your question about the real estate, depends where you are. I think it's going to be strong spots, and the bigger cities that have the looser immigrant policies are going to suffer on real estate.
What is an EMP, and should we be concerned?
It's an electromagnetic pulse, and it's apparently triggered by a nuclear device or other similar technology, and it's been talked about for a long time. The Russians apparently have the dibs on this one. Apparently it's supposedly, and I don't have the inside dope what our military has or doesn't have, but you blow one of these things up in the atmosphere, and the pulse is so great it sort of fries technology everywhere. And if one of them goes off, and it could be sent up by Korea, China, it doesn't have to be Russia, or it could be the Iranians. I mean, that could just put the country out of business. I mean, if the internet went down, satellites, there's no communication. Ultimately, there's going to be food shortages. There's going to be communication disruptions on a huge scale. Water, fuel, everything could come to a halt, and it could end up in serious riots and a situation which is as bad as a war in the on ground war situation in terms of looting and violence and so forth. So, but the EMP is a risk, and there's all this talk about it, and it could happen. So you don't need a physical invasion of the country to put the country out of business, and that's one technique. So you got to read up on it. EMP, electromagnetic pulse, very interesting, and unfortunately, the technology is there.
The moon, sunspots, and geocosmic events. What's the latest?
The latest was that there was a minor event. They call it a CME. It might graze the Earth. It's a filament of magnetism that they're looking at that it may from the sun that may hit in the northern atmosphere, and they're talking about it happening here between now and February 4th. I don't think it's going to be significant. It's just going to be magnetic pulse from the sun. It's going to create some more auroras in the sky. They're just reading, you go to spaceweather.com, you can read about it. On the geocosmic front, as I mentioned earlier, you've got the vernal equinox coming up in March. You've got a new moon coming up here, I think February 9th, which could possibly be, coincident with some change point in the markets. So at least on the solar front, there's nothing dramatic. There's something heading our way. They refer to it as a glancing blow on Sunday, February 4th, hitting the Earth, but it could just, from what I'm reading, spark a minor geomagnetic storm. Nothing, serious. But that obviously they can misread the data, and it could be much more significant. And one day we're going to see the Carrington type event that occurred in the mid 1800s, and it may come as a surprise even to those who are tracking this as carefully as they think they are, and in which case that the effect of that could be as bad or worse than the EMP we just talked about. So, it's like anything else in the geocosmic sphere, whether it's sudden earthquakes, a polar shift, an asteroid, all kinds of things that can happen. These are things we have no control over, and unfortunately or fortunately, over the millions of years, it does happen periodically and changes things dramatically along the way. So, hopefully we don't experience it in our lifetimes, but it's bound to happen because it has happened in the past, and it's been proven by studying geologic samples and studying the Earth's crust and all kinds of measurements about what has happened in the past in terms of sudden, cosmic events that change the planet in a dramatic way. So seems like every, what period of time you want to use, every 50 or 100,000 years is something dramatic that hits the planet that changes everything for everybody. So let's keep our fingers crossed in the meantime.
What's the latest on the push for a totalitarian new world order?
Haven't heard much about that. The Davos meeting that we just had in Switzerland, the World Economic Council, and Klaus Schwab, and all that stuff. There wasn't as much talk about it this time around. Where the talk about changing the whole economic front and making the world more socialistic, and the whole World Economic Group philosophy. There's not much press on this go around, as we've heard in previous years, but it's still out there, and it's a socialistic viewpoint to the extent that they say you'll own nothing and you'll be happy, and it's not going to happen. I mean, Russia's not going to let it happen. They want to be independent. China certainly wants to control the world, and they don't want that to happen. So is Klaus Schwab going to have more power than two major players? I'm sure North Korea doesn't want to be controlled by anyone either, and Iran for sure. So this World Economic Council and the socialistic movement, I think, is going to fade away and be forced out of existence. So I'm not too worried about it. But in the meantime, there is talk about digitizing our currency here in the U.S., and I think that may fade away too. I think people are going to realize that takes away their freedoms. There are plans for it, but I don't know if it's going to be implemented so quickly. So I'd be more worried about your bank account suddenly being converted to a digital currency overnight than worrying about the World Economic Council taking over everything. So it's just take it a day at a time there. I think we have too many other problems. I don't think politically this is a favorite approach right now on the digitized currency. On the other hand, though, crypto is still strong, and we didn't really discuss much of it, but the Bitcoin is still in play. XRP, many of the digital currencies are still in play, independent of the national type digital currency that everybody's worrying about, and particularly with that ETF created from Larry Fink and BlackRock. We're going to see, more and more portfolio managers taking positions in Bitcoin, and I think the realization came, I think, clearly on the part of Larry Fink that this is here to stay, and it's a way of transacting business internationally, and it's a way of transacting business outside the system, which a lot of people want to do, and a lot of people around the world don't have checking accounts or cash or the ability to do things that Bitcoin allows them to do or similar cryptos allow them to do. So it's a wave of the future, and I think that's a factor. And we also have to keep in mind what's going on with the BRIC nations, We didn't discuss that too much here today, but, they're still very active in trying to change the way we do business around the world away from the U.S. dollar and creating a currency perhaps back with gold. So those forces are also underway, and it's just a matter of time until they take more and more control of what's happening in our trade. So a lot of stuff going on, Jim.
In the 2020s, are you sensing in general people are actually dumber than you thought they were?
I've been thinking that for a long time. The average person on the street, if you ask them questions about the state of the country or the history of their country, or even understanding history, it's a total ignorant response. I mean, it's incredible. I mean, I became proud of the fact that I was a student of history or read a lot and know what's going on. But in the interviews you see on TV, when they pick up people on the street and ask them some basic questions about any subject, nobody seems to know the answer to anything. So the educational system has been horrible, at least here in the United States, and it's just remarkable to me. It seems like it's just the deterioration of the educational system. And you ask them about a sports team or a sporting event, they'll know more about that than in terms of basic things about doing business or basic things about the country or basic things about the Constitution or the Bill of Rights or what the country was based on. And I think that's one of the reasons we've had problems in the country. It's the dumbing down of America, and the dumbing down of America has let those who are subversive take advantage of the country. If you're not educated, you don't understand history. You don't understand history can repeat itself. You're vulnerable to an influx of this type of change. So, unfortunately, that's the case, Jim.
A Delaware court ruled Elon Musk's $56 billion pay package is unfair to Tesla shareholders. Do you think a $56 billion paycheck is the right thing to pay him?
I do. I think he's the Edison of our time. We are honored, when you think about it, that we live in a time where we have a man like this creating events, creating products and events that are changing our lives. In fact, just as you know, there's another company, Neuralink, has been giving some press here in the last week or so with this implant into the brain that he has sponsored. The Starlink system, the Boring Company, Tesla. We can go down the list of the projects, SpaceX, that he's been instrumental in. This man is priceless. So as far as I'm concerned, we're lucky we have a man like this in our existence that's creating and generating new technology and employing people and moving the planet forward. I mean, who else on the planet is planning a Martian base and mission? No one else. I mean, this man is so far beyond anything we have as he referred to as a common citizen. There is no level of compensation that's too great. Not only that, he's earned it. His car company, Tesla, is the largest on the planet, the most successful. The biggest car companies can't keep up with it, even though some of the sales are down because people decided they wanted hybrids more than just EVs in the last year or so. But still, he's the majority provider of the EV product, despite all the competition, which included Chinese companies, which included American companies. So that's just one aspect of it. So long answer, short answer is yes, I believe he's entitled to it.
What's going on the crypto front?
Nothing much new except what I mentioned a moment ago. I mean, we're just trading sideways here, and then stages to move ultimately higher, particularly with regard to Bitcoin itself. So I'm a bull. It's going to be volatility. We saw what Bitcoin can do in terms of price swings here in the last 3 years, but I'm looking for a move toward 80 to 100,000 a coin the next couple of years. So, my opinion is if you're interested in Bitcoin, there's that ETF that BlackRock has created and do some dollar cost averaging, by a little bit every month or so. And over time, I think you'll do fine. But I also think Ethereum and XRP and some of the others should do well as the realization comes that this is the best way of most efficient way of transacting business. So new world out there, and it's definitely a allocation in a portfolio. And if you want to trade it, there's plenty of opportunities to trade it along the way. So I'm a bull on it. I think it's just common sense. And the fact you have big players like BlackRock involved just tells you, where it's headed. Remember what happened when they created GLD, the World Gold Council, the GLD being the ETF for gold. It created more buying interest in gold because of that ETF existed, because when you bought the ETF, managers had to go out and buy the physical gold, and that helped drive prices higher. So the same thing's happening at least with the Bitcoin ETF, and I guess all the others will tag along with it as it moves higher.
Mark, where can people find out more about your special offer?
Yes, please go to vrtrader.com. Again, we have our annual forecast model coming out this week. I think it's something you really want to take a look at. And we can buy that at 50% off using the promo code 2020 half off at vrtrader.com. Just with the homepage, you'll see a little picture there of the VR forecaster, and just click on it. Thank you for mentioning it.
Mark, thank you so much for being on This Week in Money.
I'm happy to. Thank you.
My guest has been Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as vrtrader.com. And, he was the number one ranked percentage gainer at the Vancouver World Outlook Financial Conference, which the annual event's on this weekend. So, Mark, you're world famous.
Thank you. I appreciate it. Notoriety. It's always nice. It helps business. Thanks for mentioning it.
Mark was speaking to us from Arizona on February 2nd. Coming up next, Wolf Richter on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclicode.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Welcome back to This Week in Money.
Thanks for having me back, Jim.
Wolf, how's the housing market in the U.S. dealing with high interest rates?
Yeah, so it's split in two. That's the situation we have now, where new houses, so those are houses that are being sold by the home builders. They have one set of dynamics, and existing homes, those are resale homes or used homes, they have another set of dynamics, and in part or largely because the home builders, they're the pros. They know how to deal with this market, and they have cut prices. They're building at lower price points. They're building smaller houses. They're going down on amenities. And the big thing that they're doing in the United States, where we have the standard mortgages, the 30-year fixed rate mortgage, they're buying down the mortgage rate. And so this is quite a bit of a cost to the builders. The average or the median price of a new house is sold has dropped by about 17% from the peak, and is down, or it had been 2 years ago. So it's quite a drop that it experienced there. The peak was a year ago, so it dropped by about 17% year over year, and from the peak, and it's back to where it was 2 years ago. And a new house, so existing homes or used homes, they're sold by homeowners. They're not the pros. They don't want to cut price. They can't really buy down mortgage rates, and so they're so that part of the market froze. Sales have collapsed. Existing home sales in the United States have plunged by a third last year compared to the prior year, to levels that we haven't seen in the data going back to 1995. So that market has just completely frozen. Sellers don't want to come to grips with the reality, and buyers are just largely staying away. So there are much fewer transactions going on. But the new house market, so this is builders selling to customers, that's actually done pretty well on the sales side. So sales have held up. They're not spectacular, but they're pretty decent. And home builders have just reacted the way that they would have to, given the market. They have to build homes. That's their business. They can't just outweight this market like homeowners do. Homeowners are trying to just say, okay, we're going to stick this out. We're going to not put our home on the market. We're just going to wait till this goes away. And builders cannot do that. They absolutely have to be in business and make money selling homes and building homes. So they have done what's necessary to move homes, and that the result is a lot cheaper homes and at lower mortgage rates. And so now a lot of sales have switched over to new houses from existing homes. The prices are not much different anymore, and with the mortgage rate down, the payments are actually lower when you buy an equivalent new house as compared to an existing house. So this dynamic has completely changed. Home builders are competing now directly with homeowners, and so the dynamics are clear where this is going, except the homeowners haven't really figured it out yet. And they're still waiting, whereas home builders can't wait. And for home builders, it's not easy either. D.R. Horton, our biggest home builder, publicly traded company, disclosed that it lost about $65 million on a hedge that went wrong. When they buy down the mortgage rates, they hedged that. And last fall and last November, December, mortgage rates actually fell, so that those hedges blew up. And so that comes on top of the costs of buying down mortgage rates, and they're also selling at lower price points. The margins are getting squeezed. But that's what you have to do to succeed in this market. You can't just try to keep selling your high-priced homes. That just doesn't work anymore with these mortgage rates that we now have. And so home builders have adjusted to their market, and they're muddling through it. Whereas homeowners have not adjusted to the market. They're still trying to get those prices from 2 years ago. And so house prices in the United States overall, they've come down a little, but not much. They've come down a lot in some areas, such as in San Francisco and in the broader San Francisco Bay Area and along the West Coast in Seattle and in some other areas. But they've gone up on the East Coast, and they've gone up particularly in the lower cost towns in the middle of the country. So in places like Tulsa and Cleveland and Detroit and in those places, Omaha, home prices have shot up. Of course, they weren't expensive to begin with. They were pretty cheap. And so they have shot up a lot, but they're still pretty affordable in those areas. Naturally, the wages are a lot lower too. So I'm not sure in terms of overall affordability if you make a local wage. But this is the dynamic, really. East Coast is doing pretty strong. West Coast prices are declining from just astronomical levels. And the competition is now the new houses that are coming on the market.
Right. With the new house, you get brand new appliances, brand new plumbing, brand new roof. You don't have to repair anything. And if you do, it should be under warranty, shouldn't it?
Yeah, that's correct. I mean, that's one of the reasons people like buying a new house, because for the next 10 years, you really shouldn't have any major expenses. Whereas when you buy an older home, one that's been around for 50 or 60 years, I mean, you're looking at a new roof, you're looking at painting, you're looking at, appliances probably, you buy new ones when you move in, but so you have that expense. And if you want to update it, you have that expense. So it can be pretty expensive to buy an existing home unless it's already been updated and taken care of.
Has the Federal Reserve finally won the fight with inflation?
Well, we hope so. Hope is not a strategy, but those are the hopes. The Fed itself is still reluctant to acknowledge that. And there has good reason to be reluctant, because inflation is not a straight shot. Inflation serves up a lot of head fakes, and we've seen that during the last big bout of inflation that we've had here in the 1980s and in the late 1970s and early 1980s. And we had three spikes of inflation that were followed by periods when inflation just was thought to have gone away. So these were the head fakes. Inflation finally ended up deep into the double digits. So this is the fear that the Fed has, and I see that. I see the underlying inflation trends in services. They have not calmed down. What we've had in inflation that was good is the price of durable goods actually dropped. So used cars fell a whole bunch. They've had a historic spike, and they fell off of that spike. Electronics, consumer electronics fell from the pandemic spike. Furniture, all the stuff, these prices declined, and overall durable goods declined by every measure. And that pulled down the core indices of our CPI measures. We also had energy prices that collapsed, so that pushed down the overall price indices. And in services, we haven't had that success. So some services came down a little bit, but other services like housing and some financial services, and especially insurance, they have not come down. Inflation has moderated in some of them, but it's still very hot, and it looks like it's gotten stuck at these levels of 4 to 6% increases a year. And these core service measures, that's where consumers spend most of their money. That's housing, insurance, those kinds of things is what consumers spend their money on. So they're really, really important, and yet they're sticky in terms of inflation. And if that doesn't improve, the Fed had that made pretty clear, that needs to improve. And so that hasn't really, we're still watching for that. We're still hoping for that because that really hasn't happened yet. What's really come down is durable goods, and they're not the prices are not going to fall forever. So durable goods prices eventually are going to bottom out, and then they'll maybe stay there or go up again. So that benefit will go away, and inflation won't plunge. Energy prices won't plunge forever either, so that will go away, and so then it's left up to services to pull that. And there's just big doubts. I have big doubts, and the Fed has doubts that services inflation will actually come down as much as it would need to in order for inflation to return to the Fed's targets after durable goods price declines were over. And that's the thing we're looking at. So I think it's premature to say that inflation, that the fight against inflation has been won. I think the progress has been miraculous, but we've had miraculous progress in the 1970s and early 1980s also, and then it just went away, and inflation respiked. So I think this will be a much longer, drawn-out fight than we want to imagine.
Could ballooning debt make it tougher to tame inflation?
Yeah, that's a problem, especially with government debt. Consumer debt is in the United States is pretty low. It's pretty moderate in terms of non-mortgage debt. Mortgage debt is pretty heavy because home prices are high, and it takes a lot to finance a home now. But the rest of consumer debt is on a per capita basis is really pretty moderate. It's not a big issue, but the big issue is government debt, and that's very inflationary because it indicates that there is fiscal spending that's based on borrowed money rather than money that's collected via taxes. So if you spend money that you collect via taxes, that's kind of neutral to inflation. But when you spend borrowed money as a government, that's a kind of an inflationary thing. And the United States is running huge, gigantic deficits that are funded by debt, and in part by debt. And so our increase in the national debt every year is just huge now, and it's running at a completely unsustainable pace. It does two things. One, it stirs up inflation, so it stirs up demand that is inflationary. Because as money gets spent, it goes out into the economy. It reaches people directly. Some of it is social spending. Some of it goes to corporations that put it into investments and do things with it. It gets spread all around, and so this is an inflationary thing. But then the other side of that is that higher inflation creates higher tax receipts, and so the classic measure to deal with unsustainable debt is to increase the inflation rates. And this makes the debt burden, the existing burden of that debt, easier to deal with for government. And because with inflation, you get the increase in nominal economic growth, and you get the increase in wages, and you get all these things that generate new taxes, and corporate profits increase on a nominal basis with inflation. And all this generates more tax receipts, and that makes the existing debt easier to pay off. So that's the dual dynamic we have, a huge amount of new deficit spending, and that's inflationary. On the other hand, the government seems to have decided that the way to deal with this huge burden of debt that we have through creating inflation, and therefore lessening the burden. And obviously, a country that controls its own currency can never go bankrupt. It can never even default on its own currency debt. A country like Argentina that's defaulting on a regular basis, they're not defaulting on peso debt in Argentina. They're defaulting on their foreign currency debts, on dollar debt, and on euro debt and yen debt, and that they've borrowed from international investors, and that's what they're defaulting on. The United States uses its own currency to issue debt, so we're not going to default on that, but it has to be dealt with, and it seems like the government decided to deal with this burden, this huge pile of debt through increased inflation.
Does higher inflation usually lead to higher interest rates?
Yeah, they kind of go hand in hand. Now, short-term rates are largely determined by the central banks. They have policy rates that bracket the market rates on the short-term side, so the 1 month and 3 month and the 6 month yields in the government treasury market. They're largely following the interest rates that the Fed has laid out. The Fed has 5 policy rates, and we're generally talking about the federal funds rate, so that's one of them, and that's the one that may have the least impact because it only deals with interbank lending, and interbank lending isn't a big factor anymore. But then it has 4 other policy rates. It has 2 policy rates that bracket the repo market on both ends, and it has other policy rates. So these are determining largely determining the short-term rates. What the Fed doesn't really control are long-term rates, and that is largely market-dependent. I mean, we have quantitative easing and quantitative tightening as our central banks have them as tools to manipulate long-term rates. So quantitative easing would push down rates because the central bank steps in and buys the bonds, which raises the prices of those bonds, which pushes down the yields, and quantitative tightening, which is the policy they now have in place, including at the Bank of Canada too. They're shedding bonds in their portfolios, and so that theoretically increases the supply and pushes down prices and pushes up yields. So that's kind of the way they're trying to determine long-term yields, but they don't really control those. But here's the thing in terms of inflation and long-term yield. If a investor buys a 10-year Treasury note and thinks that inflation is going to average 2 years over the 10-year period, then a 4% yield on a security like this where there's really no credit risk sounds pretty good. So if you think inflation is going to average 2% over 10 years, you're willing to pay 4%. You're willing to pay a price that yields you 4%. And yet, if inflation turns out to be 5% on average for that 10-year period, you're losing. Your interest payments are not compensating you for the loss of purchasing power of your note, and you come out in the hole at the end. And investors don't like that. So if investors broadly believe that inflation over the next 10 years is 5%, the yield of 10-year notes will be far higher than that. So you're looking at 7 or maybe 8% yields on 10-year government debt. And so this has not happened yet. So far, everybody believes that inflation will just sort of go back to 2%, and it's not there now, and it looks like it might head there, but we're expecting head fakes, and the Fed has its doubts. But if it goes to 2%, yeah, that's a deal. But if it goes back up, and then these bets will change, and so you have inflation determining long-term interest rates if investors believe that inflation will reach certain levels. That's the thing, investors have to believe something. If they believe that inflation is 2%, the yields accommodate that. So that will be where yields will be. If investors think inflation will be 5%, that's where yields will be. And so it's really how investors project the trajectory of inflation that determines long-term yields today. And right now they're with the 10-year yield around 4%, and dropping today. The feeling is that inflation is going to go back to 2% and will stay around 2% for the next 10 years. And that's the sense, and that's what they're betting on. And if that changes, so if that perception changes, and if it goes to, well, we're going to have high inflation for longer, and it's going to be 4% inflation for the next 10 years, then yields will radically go higher.
Is the electric vehicle market going through growing pains?
Yeah, the growing pains in the sense that the new EV makers that we now have, they're having trouble producing enough, and they're struggling to ramp up production. Even Tesla, it's just started the pickup truck production. It has a hell of a time ramping up production on it, the Cybertruck, and it's sort of maxed out production on its other products. Rivian, which is a startup, makes a good pickup truck. They're struggling mightily to get production up. I mean, it's just really hard for a small company, for a new company, to manufacture complex products like that at scale. And so that's been the issue. Tesla has been over-promising production targets from its first day of existence. It never really could quite get there. And nevertheless, sales are booming. We see this everywhere. The younger companies like Rivian, they have triple-digit sales growth year over year. Tesla comes in, double-digit sales growth. They're lower than they used to be, but it's still running over 30% sales growth in the United States, and 25%. I mean, California, we tracked it with registrations here in California, and it's a confined market, so it's a smaller market than overall the United States, about the size of Canada in terms of the market, and but we have good registration data there. And Tesla is crushing Toyota. Toyota's market share has dropped to about 15% in California. Toyota and Honda were the number one in California for many, many years, and their products were the best sellers, and nobody could even get close. And Honda is now number 3, Tesla is number 2, Toyota is still number 1, but its market share has dropped to 15% from 17% a couple of years ago, and Tesla's market share has shot up to 13%, so they're just 2 percentage points apart. And if that continues, within a year or two, Tesla will be the number 1 automaker in California. And Tesla already has the number 1 and number 2 best sellers of all vehicles in California. The Model Y is number 1. The Model Y outsells the best-selling Toyota by about 150%. It is just amazing how far ahead Tesla has pulled in terms of its models with compared to Toyota. The Model 3, which is the number 2 bestseller in Oklahoma, in California, also outsells the number 1 bestseller that Toyota has. So these are the 2 models of all vehicles, that have a lion's share of the market in California, and sales are just growing in leaps and bounds. They still are. Tesla is running into production constraints. It built a new factory in Texas that's now up and running for its cars and SUV production. It's got the factory in California, and it's sort of maxed out. It's building it started producing at its pickup truck factory in Texas. But that ramp up is slow. So there are these production problems. I mean, that's the issue really with EVs right now. They're coming out of nowhere. The supply chains aren't big enough. Ford and GM have struggled trying to get the supply chains put together. They have not fully committed to that. I mean, they're making the money on ICE vehicles. So they're doing share buybacks. They announced combined $7 billion in share buybacks recently to prop up their shares instead of really pushing the EV strategy. And so they're losing out, and they're having trouble getting this going. GM had the third best-selling EV in California, the Bolt, and it did well. It sold at the lower end, so with the federal incentives, you could buy a Bolt for $20,000 roughly. And that's a very attractive price point for a new vehicle. There are not many new vehicles you can buy for $20,000. And it was a very nice vehicle, had a great performance. It wasn't just a little econo box. And so people bought it. It had a record sales in 2023, and then GM killed it. So now it doesn't have anything that it mass produces. It's going to come up with a new Bolt in the future sometime, but no. I mean, it's just really vague, and we don't know when. And it's got some other EV models that it's trying to market, but it had setbacks, production and quality setbacks on those, and Ford did too. And so it's just a real struggle for them. On the other hand, Kia and Hyundai, they're having pretty good luck with their EVs, and they're making major headway. And so in 2024, with the Bolt gone, they're going to be likely the number 2 in the EV market in the United States, and their growth patterns are strong. So Rivian they're growing at over 100% a year in terms of their production sales. So they're going to be a major player pretty soon. And so the dynamics are really fascinating. And I've been in the car business, and it's close to my heart. And it's the most fascinating thing I've seen all my life. You have this one new propulsion method that's coming in, and that's shaking up the entire, half-asleep auto market. And you had oligopolistic pricing with pickup trucks. There are, in the United States, full-size pickup trucks. There were only really 3 pickup truck makers. There's a 4th one, but Nissan, but they pulled out now, and they never had volume sales. And so they never competed on price. There are 4 pickup truck makers, and they never really competed on price, so they got really expensive. Now you've got companies coming in competing on price, and Tesla has been cutting this price on its SUVs and its cars, and that's really a good thing to see. That's what Americans need. We need price cuts after new cars have gotten so expensive. To see price cuts, that's great, and automakers are going to have to follow that. And so this is the big movement that we're seeing is EVs are really shaking up the legacy automakers. They've lost market share in leaps and bounds, and meaning the American legacy automakers. What has gained market share is Tesla, is of course the other EV makers, and is Hyundai, Kia. And they've done a great job, and so they've set a new sales record in 2023, and in the United States, and none of the other automakers have. I mean, they have miserably low sales. Their peaks were many years ago, and they've just improved their dollar sales by hiking their prices, and that's just hard to do now when you have automakers that are in here cutting prices and taking market share.
What's happening in the new and used vehicle markets, and are they a warning indicator for the economy?
Well, what's happening is a big sales surge in 2023 for new vehicles. So they jumped by something like 12% from a year ago. But the sales levels in 2023 were a lot lower than they were in 2019. And that's been an issue for a long time. In the United States, we had roughly 3 peak years, and they're all kind of the same. The first peak year was in the year 2000 at about 17.3 million vehicles sold. And then we had another peak year in 2016. That was just a hair higher than that, about 17.4 million vehicles sold. In 2019 was another one. And so we really haven't gone anywhere. That 17.5 million vehicles per year is the peak. We've had that in 2000, 23 years ago. We've had a couple more times since then before the pandemic, and now we're at around 14 million. And so we're way below that, 15 million. Maybe this year we're going to get 15.5 million. And during the pandemic, we were lower than that. And so it's going to go back up. There's some pent-up demand. And by the time we get closer to 17 million, it'll have peaked and it'll drop off again. It's the same thing. The new vehicles are too expensive. Despite population growth, we have not been able to show a growth pattern in new vehicle sales in the United States. And it's been the same in Europe. It's been the same in Canada. It's been the same in all developed markets. And that's reality. So what has happened on the side of that is that consumers have shifted to buying used vehicles, and that's turned into a very big business. The supply to used vehicles comes from fleets, so largely. So that is rental car fleets that supply 2 to 3.5 million vehicles a year to the used vehicle market in the United States. So that's quite a bit of supply. Then we have the trade-ins at the dealers. We have the lease turn-ins. And there's 20-some million used vehicles sold in the United States per year. So that's more than new vehicles. And that market has gone crazy during the pandemic. So we've had 60% price increases in the 2-year time span, which is completely nuts. So now that market is struggling with that. People are no longer willing to pay those prices. So after that historic price spike, we have seen a historic drop in prices, in used vehicle prices, but they're still much higher than they used to be, but they've given up a little bit over a third of that price spike. And used vehicle sales have slowed. So new vehicle sales last year were up 12% from a year ago. So that's what happened there. Used vehicles that sort of stagnated at these kind of normalish levels, but it's facing this price ceiling, and people are now more critical of paying those prices. Interest rates have gone up, so people who have to borrow money to buy a used vehicle, they're more particular about it. So it doesn't show a lack of demand. It shows a structural issue in that the price spike in used vehicles that we had during the pandemic has to come down. And that's hard to do. We've had several online used dealers, big publicly traded used vehicle dealers go bankrupt now. We've had a bunch of subprime specialized dealer chains go bankrupt. So we have these issues there on the corporate side, because it's very difficult to digest a drop in prices like that, and companies have to lower the prices to sell. And consumers want to buy, but they don't want to pay those rip-off prices anymore. And there was, when you remember, a couple of years ago, there was a time when you had to pay more for a used vehicle than that used vehicle cost when it was new. And it was just completely crazy, and people are less and less willing to do that. So I think that used vehicle market will continue to have to deal with this pricing issue, and these prices have to come down, and they don't have to go back all the way to where they were in 2019, but they have to come down some more, and I think that's a good thing for American consumers. It was just a period where they got ripped off, and And everybody else too. Insurance companies had to pay these replacement costs that suddenly had spiked by 60%. So insurance companies hiked their insurance premiums by 20% per year for 2 years in a row. Yeah. So you have that, and consumers are paying that. And that's where part of the inflation comes from, is through insurance rates. Auto insurance is just completely out of whack now. When the CPI for auto insurance is up 21% year over year, and that's because of that used vehicle price spike. And now it's working its way down, but it really hasn't come down far enough yet. And I'm looking forward for the used vehicle market to normalize. I mean, this craziness in the used vehicle market was just astounding.
Where is the best place for people to follow you?
Wolf.Stock. It's free. There's no paywall. We don't sell anything. Advertisement supported and donation supported. It's all business, finance, and money. We don't do politics. So Wolf.Stock.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of Wolf.Stock. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Mark Leibovit, and Wolf Richter. And thank you for listening. If you have any questions for anyone on the show or for the show, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.